Welcome along to the Deep Dive. This is prepared for you by QIP.Capital Academy.
Great to be here.
Our mission, well, is pretty simple, really. We take complex topics and try to break them down into clear, digestible insights, get you informed, fast.
That's the plan.
And today, we are diving headfirst into the, let's say, often pretty intense world of crypto investment strategies. We're focusing on that big debate, day trading versus HODLing. Two really different ways to approach, the same volatile market.
Yeah, totally different philosophies. So this deep dive will unpack what each one actually involves, the pros and cons, the risks, and maybe help you figure out which approach, or maybe even a mix, might work best for you.
Okay, let's start with the first one then. Crypto day trading. It sounds exciting, maybe a bit glamorous, but what's actually involved?
Well, it's a short-term game, really short-term.
Like same day.
Exactly. Buying and selling cryptocurrencies within the same day. The goal is to grab profits from those small, quick price moves.
So you need to be watching things constantly.
Constantly. You're relying heavily on technical analysis, looking at charts, spotting trends, glued to the screen, basically.
What's the appeal then? Why do people do it?
Well, the potential for quick profits is obviously a big draw, especially with crypto being so volatile. That volatility creates opportunities, right? And, doing it intensively, you can develop a really deep understanding of the market mechanics. But, and this is a big but, our sources are really clear on this, it's extremely high risk.
Extremely high. You mentioned technical analysis, chart patterns, indicators.
Right.
But what about the real world outcomes? What do the numbers say about day traders?
Yeah, look, the stats aren't pretty. Most sources suggest something like 80, maybe even 90% of retail day traders don't make consistent money over, say, a year.
80 to 90%. That's huge.
It is. And many just burn out fast. It's not just about picking winners. It's the constant attention, the emotional pressure, the discipline needed.
Decision fatigue, I guess?
Definitely. And we haven't even mentioned transaction costs. Lots of trades mean lots of fees, and they can seriously erode any gains you do make.
Okay, that's a very sobering picture of day trading. So if that sounds, frankly, terrifying or just too intense, what's the main alternative?
Yeah.
That brings us to HODLing, right?
Yeah.
Which has a funny origin story.
It does. Yeah, it famously started from a typo in an online forum post years ago. Someone typed, "I am HODLing" instead of holding.
Yeah. Right.
And it just stuck. It became this sort of rallying cry, an acronym for hold on for dear life.
Hold on for dear life. I like it. So what's the strategy?
It's fundamentally long-term. You buy crypto and you hold it for ages. You try to ignore the short-term price swings, the market drama.
It's so much less frantic. What are the upsides here?
Well, the big one is lower stress.
Right.
It's way simpler. You don't need to watch the market every minute.
Okay.
And there's potential for really significant long-term growth. I mean, look at Bitcoin's history. People who bought early and just held on.
Yeah, through thick and thin.
Exactly. They saw incredible returns. Plus, fewer trades mean, obviously, much lower transaction fees. Almost negligible sometimes.
Seems much more manageable.
Right.
But it can't be all smooth sailing, can it? What are the challenges or anxieties with HODling?
No, you're right. It has its own set of difficulties. You're totally exposed to big market downturns, bear markets. Your portfolio's value can drop dramatically and stay down for a while.
So patience is crucial.
Immense patience. Returns aren't quick. You might wait years. And there's opportunity cost, too. You see these short-term spikes you could have traded, but you're holding.
Right. You miss out on those quick wins, potentially.
And let's be honest, there's always the risk that a specific crypto project you're holding just fails. Becomes worthless over time. That's a real risk.
Okay. So if we put them side by side, day trading versus HODling.
The contrast is pretty stark, yeah. Day trading, huge time commitment, very high risk. Remember those failure rates and high fees.
Okay.
HODling, low time commitment, generally seen as medium risk overall, though still risky, and low fees.
So there's no single best way, is there? It sounds incredibly personal.
Exactly. It boils down to you. What's your tolerance for risk? Are you okay with potential big losses for potential quick gains? Or do you prefer a slower, maybe steadier path?
And how much time can you actually dedicate? Day trading sounds like a full-time job.
It pretty much is. If you want to do it seriously, HODling is more passive.
Yeah.
Then there's market knowledge. You need way more technical skill for day trading.
And emotional control too, right? Not panic selling or getting greedy.
Oh, massively important. For both, actually, but maybe more intensely tested with day trading.
Which leads to maybe a middle ground. A hybrid approach.
Yeah, that's a really popular option for a lot of people. You don't have to be purely one or the other.
How does that work in practice?
Well, you might keep a core portfolio of cryptos you believe in long term. That's your HODL part. But then you set aside a smaller, separate amount of capital for more active short-term trading.
Ah, okay. Kind of the best of both worlds. Manage risk, but still try for some quicker gains.
Potentially, yeah. It diversifies your strategy, lets you adapt a bit more to different market conditions, perhaps.
So, wrapping this up then, the message seems clear. There's no magic formula.
None at all.
Your choice, day trading, HODling, or that hybrid approach, it really has to match your own financial situation, your goals, how you feel about risk, and how much time you've realistically got.
Absolutely. And, here's something maybe to leave you thinking about.
Go on.
Beyond just picking day trader or Ocho dealer, what seems to really separate successful crypto investors from the rest, whatever their style, it's the ongoing stuff. Consistent personal research, your own research, not just following hype. Diligent risk management, never investing more than you can afford to lose. And, maybe underrated, keeping a journal.
A trading journal.
Yeah, tracking your decisions, why you made them, what the outcome was, learning from your wins and your losses. It's less about predicting the market perfectly and more about managing yourself within it.
Mastering yourself, not just the market. That's a great final thought. Thanks for breaking that down.
My pleasure.